This episode is brought to you by Tegus, the future of investment research. If you follow my newsletters, you know that Tegus is one of the things I use most often. Almost every post I have has some clip from an expert call or some quote from a management transcript that I've got off BMSEC that, it's because of Tegus that I've got access to all of that. It's revolutionized how I get up to speed on new industries and companies. I've been a happy subscriber of it for over 3 years now. And I tell you, I use probably every day I'm logging on to Tegus to look at an expert call transcript. And I certainly know, my BMSEC, I'm glad that it's unlimited because I am looking at BMSEC all the time. I'm looking at my Google Chrome right now and I have 30 tabs open and I'd say 18 of them are from BMSEC. So between Tegus and BMSEC, I am a very devoted user here. Look, it's one platform where you can dive into expert call transcripts, management checks, panel calls, and detailed financial data. No more fragmented data sources or endless searching. Tegus brings everything together, giving you a crystal clear view of the industries and companies that matter most. If you're ready to supercharge your research, visit tegus.com/value. That's tegus.com/value. Trust me, once you've experienced Tegus, you won't go back to your old way of doing research. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on, I think it's for the third time, my friend and the author of Value Situations newsletter, Conor Maguire. Conor, how's it going?
I'm good, Andrew. Thanks for having me on again and good to speak with you.
Look, anytime I can get a great Irish accent on the podcast, you've got to go for it. So look, we're going to talk about one stock in particular. We might bounce a few others as we go. But before we get started, just a disclaimer to remind everyone, nothing on this podcast is investing advice. That's always true, but for my domestic listeners, maybe particularly true today, we're mainly going to talk about international, particularly European stocks. So remember that comes with maybe a little bit of a little bit of heightened risk, maybe some tax consequences, everything. Not tax advisors, not financial advisors, consultant advisor, do your own work, all that sort of stuff. Conor, the company we want to talk about today, you correct me, I thought it was Dowlais. It is Dowlais. The ticker there is DWL. It trades in London. This is, I know it's been many event investors' favorite stock for 2-ish years, but I'll just toss it over to you. What is Dowlais and why are they so interesting right now?
Yeah, no, thanks, Andrew. Actually, I had to laugh when you put out the post about our discussion on Twitter or X the other day, and there was no comments on the back of it. I think from the last time I checked, and I take that as a sign that this is one of those kind of obscure stocks that it's a small cap or mid cap UK listed stock.
Can I pause you there real quick? No comments, but I will say several serious event investors did email me questions. So there are serious guys following this. And I just want to note, Conor's been covering this nonstop. I'm going to include a link to his coverage in the show notes. So if you're listening, you want to read it, please follow the show notes. But Conor, sorry to cut you off. I just thought both those were nice addendums. Please continue.
No worries. Thanks, Andrew. It's good to know somebody's interested in it. So yeah, it's one of these kind of smaller mid-cap UK stocks that has kind of really been forgotten and overlooked. So it's an 820 million or 830 million market cap auto parts business listed in the UK. So it was a spin-off in April last year from another UK listed business called Melrose Industries. So Melrose is kind of a listed private equity kind of turnaround specialist. And they bought a business called GKN PLC back in 2018, which is this auto business and another aerospace business, which they retained and still own. So following a kind of 4-year period of restructuring, they spun off Dowlais last year. And so this business, it's an auto parts business. It comprises 2 segments. The main segment or the core business is about 80% of revenues, and that's GKN Auto. And then that has about 4.2 billion in revenues last year. And then the other segment, a smaller part of the business, which is non-core, I suppose, at this point, and is kind of part of the event-driven angle on it, is GKN Powder Metallurgy. So that's kind of a specialty metals processing business. That's about 20% of the revenues, about 1 billion in revenues last year. So, I think what makes this business interesting is that it's, as I said, an 820 million market cap stock today, but the carrying value of the powder metallurgy business, or which I'll call just Powdermet, is about 860 million. So, you've got a sum of the parts here that looks pretty interesting. And yeah, I know usually people would say some of the parts don't work, but the difference here is that at the time of the spin-off, management had flagged that they were going to consider demerging or selling or exiting the Powdermet business at some point in the future. Over the last couple of months, they've announced a strategic review where they're now exploring the sale of that. The business separately at the time of the spin-off also owned kind of a startup hydrogen technology business. They've sold that. It was loss-making, so that will actually be cash flow accretive going forward. So they've got rid of that. They're now looking at the Powdermet business, which could be worth in excess of £1 billion sterling. Again, kind of exceeding the current market cap of the entire business. And then you're left with the core auto business, which is actually the global market leader in the auto components that it produces. So it kind of produces a kind of a number of auto components, kind of to do with kind of the kind of mechanical transmission. So everything to do with kind of the moving the power from the engine to the wheels and rotating. So these are fundamental components. It's not like they're luxury kind of features or anything that could be added on to a car's spec. These are fundamental auto components. So it's estimated 1 in 2 cars globally has a GKN auto component in it. And they deal with 90% of global auto manufacturers. And also, interestingly, just with the auto market has obviously been a tough industry this year. And there's been much discussion of the slowdown in electric vehicles, except for Chinese manufacturers, which have really launched an assault on Europe and to the US, in the US to a lesser extent. But interestingly,
you got to be careful when you say China's launching an assault on Europe and the US. I mean, that's a whole different geopolitical risk we're talking about.
Well, just in terms of kind of just trying to grab market share like they've done with solar panels and countless other kind of products, or in countless other industries. So the Chinese electric vehicles are the one part of the auto market that you could argue are actually doing well, and that they're gaining market share, they're growing. And again, Dowlais is a supplier to the top 10 auto manufacturers in China, including all the major EV manufacturers. So it's really well placed within that, in the current market context. And then also just in terms of the classic debate, or the debate in recent years between internal combustion engines assumed to be dying out, future is electric. And I think we kind of learned in the last 6 to 9 months that the electric vehicle transition is going to take a lot longer than maybe previously assumed. You see all the major manufacturers now pulling back investment plans. So again, Dowlais has a pretty, what they call a kind of a powertrain agnostic portfolio. So the powertrain, again, is that mechanical kind of base of the car, about the transmitting power from the engine to the wheels. So they produce components for both electric vehicles and for the traditional internal combustion engine vehicles. So they're kind of nicely balanced in that they can straddle both markets. So if the EV side of the industry is kind of slowing down currently, they have got attractive exposure to the Chinese part of that, which is doing relatively well. And then also, if there's a slowdown in electric vehicles and there's a slowdown in investment, that if the global auto fleet is to continue to be, it's aging, if it's to be replaced, people will continue to buy cars. Internal combustion engines are cheaper and more convenient for the time being. That's also positive for Dowlais because it already serves that market, and it's the market leader in that segment in terms of the components it produces. So in terms of just the business, how the business is positioned, it's in a difficult and at times cyclical industry, which is going through a tough moment at the moment. But medium to longer term, I think its prospects are pretty solid, and I think it's pretty well positioned across the different trends within the industry.
Let me pop in here. That was a great overview. First question, I want to dive into a lot of things you talked about. I was pulling up some charts because I've been following this stock off and on for pretty much since the spin, in part because of your coverage, in part because of someone else's. So I was pulling up some charts, and as you were saying stuff, it was reminding me of other stuff I wanted to ask. But so we'll get into all that. But first question I like to ask everyone. Market's a really competitive place. As I mentioned, multiple very smart investors I know who either emailed me when I said I was doing a podcast with questions, comments, concerns, or who have just talked about this in the past, right? So this is not an unknown company. It's followed. Market's a competitive place. What do you think you're seeing that the market is missing that kind of makes this an alpha opportunity?
Okay, so I think I suppose it comes back to, I mentioned there kind of how the business is positioned, and if you can take any kind of a constructive view on a medium term, forget about the short term. The next 12 months, we all know the headwinds that are facing the industry, but on a medium term basis, I think its prospects are solid and it's well positioned in that context. That's just in terms of business quality, business positioning. That's I suppose that element covered. What makes it more interesting to me is, as I touched on already, is the event-driven angle, whereby this is now an event-driven situation in that the Powdermet segment, it looks like they will divest it. And I would have thought, when you look at kind of the kind of historic transactions, private equity or strategic acquirer is more likely than a kind of a share spin-off. And on that basis, when you look at, if you look at how comparable businesses to the Powdermet business have traded, so there's only one really direct peer, which was a Swedish business that was acquired by private equity about 10, 12 years ago, called Höganäs. That was bought for 10 times EBITDA. That's probably the most relevant. If you then look at kind of current listed businesses that are broadly comparable, you're really looking at a couple of US names: Carpenter Technologies, ATI, Amatec. They're more diversified businesses than Powdermet, but they're trading at 16, 17 times EBITDA on an LTM basis. But then you compare Powdermet's free cash flow conversion and EBITDA margins to those US listed businesses, and it holds up pretty well. It kind of has stronger cash conversion than ATI and Carpenter. It's kind of 73% free cash conversion, and it's got 15, 16% EBITDA margin. So pretty solid metrics, compared to those peers. So if you put a 10 times, they're trading at 15, 16 times. The private comp I mentioned traded at 10 times. Oh, that's a very dated transaction at this stage. But, it's not unreasonable to think that this is worth 10 times. And you apply a 10 times multiple to that segment's, the Powdermet segment EBITDA, you get a value of about 1.5 billion. Even if you allow for tax leakage and costs and so on, you're talking, value for that segment that should be worth in excess of £1 billion sterling. Again, you're looking at the market cap of Dowlais today, and that's 830 million or so. So, you've got a transformative divestment there in terms of, £1 billion plus in cash proceeds that comes back to the core business. Management have already implemented a buyback. It's a small but limited buyback, £50 million. So small, but it's with on a divestment, you can easily see scope for an expanded buyback. They've demonstrated appetite for shareholder returns, or kind of a special dividend. So I think that event-driven angle is attractive. And then again, I suppose if you look at it this way, either the Powdermet business, the carrying value is about 860 million net book value. In excess of that maybe as if it's traded to the private market. So you're either getting that for free at the current market cap, or if you back that value out of Dowlais' current EV, it implies that the core auto business is trading at less than 2 times EBITDA. And even in this market, which is challenged, and you look at listed auto peers like Dana Incorporated in the US, American Axle, Borg Warner, they're all trading at kind of 4 times EBITDA. So, even Vitesco, which I think Greenlight, David Einhorn was pretty bullish on, that's been taken private by controlling shareholder at about 5.5 times EBITDA. So,
I remember that deal.
So the core auto business, you're either getting the Powdermet segment, which is £1 billion plus business, for free, or the other way of looking at it is that the core auto business is trading at a 50 to 60% discount to peers. So that's where the value is. And you would have to think now, with all the negativity, I mean, this spun off at £1.46 a share. It's trading today, or yesterday it closed at about 60 pence. So it's down down significantly. So you'd have to think a lot of the negativity is already priced into the stock. It's kind of it's a market leader in its niche, and it's priced like a penny stock, and it's got a segment that no one is valuing or reflecting in the market cap.
So let me just stop it. So if I had to boil that down, what I think you're saying is, look, my variant view, my is this whole company is priced like a a pretty rapidly declining shell, right? Like we're talking about the
Yeah.
whole company trading for, I don't know, you tell me 3.5 times EBITDA. Tell me,
Yeah, about
plus or
4 times,
minus.
about four
Yeah.
times EBITDA. Yeah.
So the whole, and you're saying, hey, I think the variant is Powdermet is a much better business than that. Look at peers. There haven't been great transactions recently, but look at loose peers. My multiple, like I think it could easily be worth high single digits or more EBITDA. And then when you do that kind of math, the implied on the remain co is just absolutely insane. Am I kind of boiling that down correctly?
Yeah, exactly. Yeah, yeah. I think if you look at kind of the private market comps, and I assume they're going to sell powder mesh, and then that leaves the core auto business, which, by the way, was also subject to a takeover bid in the past. At the time, Melrose bought the original predecessor business. I mean, it's you can make an argument it's likely too small on its own, or it's ripe for a kind of a strategic acquirer like Dana, who tried to buy it before at about 7 times EBITDA back in 2018. So, the core business, so on a breakup basis, on my numbers, it could be worth about £1.70 a share. If they sell Powdermet and it kind of, re-rates over the next 3 years as the auto market kind of stabilizes again, I think it could be worth over £2 a share. So, compared to 60 pence today, I think there's substantial upside. And then when you look at the downside, so, I think it's, at 2 times EBITDA on the core auto business, a very attractive Powdermet segment that kind of covers all the debt and would de-risk the balance sheet. I think the downside is limited. I think a lot of the negative sentiment out there is already priced in. So, at the kind of share price there. So I think it's a pretty asymmetric setup.
I want to talk about history here. And generally, I don't like to talk too much about history, but there's two angles I want to talk about the history here. First, everything you're saying, right? Like the stock's been kind of a disaster since the spin. But let's just focus on the recent forecast. And, it's the first thing anybody's going to look at when they hear this pitch. They're going to pull up the stock chart and just see like down into the right? So yeah. I want to ask you this history in a few different ways. Let's start with the recent history. There's a quote in your most recent article. It seems in the space of 3 months, Dowlais revenue growth has shifted from slightly below prior year to mid to high single digit declines. Operating margin expansion and free cash flow, they thought they were both going to grow or expand, declines now. So I just want to ask you, like, what's happened with the recent past? And we can bolt onto that. As you mentioned, I follow several names in the auto space. The auto space has not been fun if you've been like an auto supplier of any form. So I want to see what's happened in the recent past and how much of the issues are Dowlais specific versus kind of auto industry supplier in general, macro, all that type of stuff.
Yeah, so I mean, at the start of the year, the outlook was for kind of revenue and modest revenue and EBITDA growth. And then there was a trading update in May, which kind of tempered expectations and kind of was essentially kind of guiding down. And then more recently, the interim results, they kind of guided down again, where kind of, revenue is going to be down for the year now, and free cash flow and EBITDA will also decline. And so that really, I suppose, spooked markets and kind of confirmed, or I suppose it was perceived to confirm kind of the wider concerns around the auto sector in terms of all the headlines about EV slowdown. And I suppose investors then kind of really started to exit the stock, and it's down, I think 40% or 43% year to date, and a lot of that has come within the last couple of months with that kind of reduced guidance. Now, in saying that, results, on a headline basis, that doesn't sound great. But when you dig into the actual underlying business performance relative to the market and what's happening more broadly, it's not as bad as it seems. 75% of the business in terms of revenue has actually outperformed in the half year to the end of June. Has actually outperformed the market in terms of the Chinese segment, the joint venture revenue growth of 1.5%. So that's outperformed. The core auto business has actually outperformed the market by about 1%. And really, where this business has suffered is in the EV, the EV components product lines. So there's about 4 kind of platforms, they call them, that have really suffered. And that the revenue is down, I think 8 or 9% for the half year. And about 60% plus of that decline is attributable to their electric vehicle component lines. And we all know about that and what's happening in that part of the market. So I suppose there's an element of that's where the market is at. And so, also I suppose, that you could level the criticism. Well, management were saying one thing, 6 months ago, and then 2-3 months ago, suddenly they've kind of really changed their tune. But in fairness, I think as well, when you look at kind of S&P mobility forecasts and other industry commentators, they had similar kind of forecasts showing kind of, a pickup in volumes, vehicle volumes, production volumes this year. And then they very quickly issued two reduced outlooks in the last kind of 3 or 4 months. So, I think industry-wide, this kind of slowdown in electric vehicles, which is really the kind of what's behind the current issues, has kind of caught most people.
This episode is brought to you by Tegus, the future of investment research. Look, if you've been reading my newsletters, you know how often I rely on Tegus for my research. I probably read 1 or 2 expert calls a day, probably average 7 a week off of Tegus. They've got the largest transcript library in the world with over 75% of the private market transcripts. Whether you're curious about AI, biotech, or any niche market, Tegus has the insights you need. What sets Tegus apart is its all-in-one platform. It's packed with expert call transcripts, management checks, panel calls, and in-depth financial data. No more jumping between different services or piecing together fragmented data. With Tegus, everything is right at your fingertips. The best part? The insights you get are from the very people shaping the industries you're interested in. You'll find perspective from insiders and executives that you can't get anywhere else. To see Tegus in action and understand why it's one of my go-to resources, visit tegus.com/value. That's tegus.com/value. Trust me, once you try Tegus, you'll never look back. Let me jump in here, Connor. So I'm with you. I think a lot of it is industry-wide. I'm not sure. I'm not close enough to Dowlais to know, is it 99% industry, 1% company, 50-50? I suspect the answer is yeah, it's less than 99-1. I suspect is the answer. But yeah. I do want to ask you this question, right? Industry's been cutting, but I've heard this argument for going on, I'm going to say 6 years now, right? Hey, go look at car SAR, right? It has come down since it started before COVID, right? But we were running at I can't remember the exact rates. We're running at 18 million annually adjusted per year. Post COVID, we're down to 17, and now we're kind of at 15. And I've been hearing for years all these auto suppliers, all these automakers saying, hey, once we get SAR back, we're in a depressed SAR mode. And at this point, it's been, I think it started pre-COVID. At this point, it's been 5 years. And I'm kind of hey, maybe this is the new SAR rate, right? Maybe we're not going back. And I think my numbers are correct. Maybe we're not going back to 18. Maybe 15 is the new run rate. And that would have a lot of implications, right? I think people are worried about this being, for a while, people were worried about this being in terminal decline as EVs took over the world. And I don't think that's coming back. But I'm worried about a structural decline where the whole industry was set up to produce parts, cars, everything at 18 million. Obviously, I'm focusing domestic, not international, but I think that many of the same things would apply. The whole industry was set up for that. And now we're at 15 million, and people are just starting to get that memo, and they're saying, oh my God, we are way too much capacity here, and there's still more pain to come. I realize I threw a lot out at you. I'm kind of asking us to predict, but that's one of the key worries I have when I look at this, or there's several interesting auto names, any of the auto names. GTX I've owned in the past, and people toss that one on around all the time. We'll probably talk about Finn, the spin. There are a lot of other auto names that trade cheaply, and that's one of the big worries I have. Not terminal decline, but kind of structurally lower run rate.
Yeah, well, I think when you look at some of the kind of the broader trends in the auto industry, certainly since, pre-COVID, the peak globally, and it's important to, I suppose, emphasize Dowlais is a global business. It's
absolutely.
It's not concentrated in any one jurisdiction. So, and again, 90% of the global, all the major car manufacturers you can think of are customers of Dowlais. And have been for a long time. So, they've kind of got global exposure. And then when you think about, pre-COVID global passenger vehicle, so this is cars and kind of smaller vans, so non-commercial or not heavy duty vehicles. So that market was kind of 95 million pre-COVID, kind of peaked around 2018, I think it was. Then it plunged into kind of 72 million vehicles globally in 2020. And it's slowly rebounded since then. So I think last year was about 90 million. And this year it's going to dip now off the latest S&P global forecast to about 88 million. And really, in terms of kind of, and Dowlais talk about this in some of their investor calls and some of the materials about kind of stabilized or normalizing volumes. And that's really, I suppose, getting back above 90 million, which S&P are forecasting next year, 2025, and up to kind of 93, 94 million, 2026. So, you know, for whatever they're worth in terms of the latest forecasts, industry forecasts, reflecting kind of the current state of affairs, the vehicle kind of production is expected to increase again. And, what's driving that is you've got in the US has, I think it's the oldest car fleet in the US now that it's ever been. I think the average age of a car on US roads is about 14, 15 years. You've got increasing kind of standards where increasing here in Europe and certainly in Ireland, older cars are getting harder and harder to keep on the roads in terms of, there's additional kind of tests and so on that they need to do, and that's a cost that all adds up the older they get. And also then you've got kind of, again, if Dowlais is a global company and you've got increasing urbanization and mobility in some of the more developing countries, and it's got good exposure into Asia as well, there's a lot of kind of structural medium term kind of supports there for a rebound in volume. So between population growth, urbanization, mobility, car aging, safety, or kind of regulatory standards in terms of what kind of a car you're allowed to drive on roads, I mean, they're all supportive. And I think, you look at that kind of broader backdrop, and then again, you come back to Dowlais' positioning in the market, as in it is the market leader in the components it produces. It has all the major relationships. That's unlikely to change. You would kind of think this is really a cyclical industry. It will and it should pick up at some point, and when it does, and it's forecast to do so within the next 2 or 3 years, Dowlais seems well positioned to capture that. And in the meantime, it's likely going to divest of a non-core business and get $1 billion plus in cash, and you've got the remain core, the stub equity at less than 2 times EBITDA on depressed earnings. That's LTM earnings, which obviously reflect the challenges of the last 6 months.
Yeah, I wonder because, as you said, it's 2x off trout earnings, which is a nice place to buy something. But one of the concerns I have with this or any of the auto parts suppliers I've been looking at is, hey, is this trout or is this the new normal? Or, are we going to go from, you mentioned 90 to 88? So you go from 90 to 88 to 86 for whatever reason. And it's just a concern that I've had. I'm sure if you and I were talking here 10 years ago, I'm sure people would have had the same concerns. And then you saw our last all-time on. Let's go back to history here. Other history question I wanted to ask you, and this was a friend who pointed out, but you mentioned Melrose bought this business through a bidding war. And I think there were other smaller businesses that were probably higher multiple that they divested. But I want to go back to the bidding war time, right? Like that was 2018. That's not forever ago. Like, what was the rationale behind the bidding war? I think most of the attractiveness was these assets, which the market kind of hates right now. Because I'm just trying to kind of read through, like, hey, can we learn anything from that 6 year ago past that applies to today about, it's cyclical, but if you look through the cyclicality, there's some value here.
Yeah, so I mean, Dowlais was originally, it's originally a part of roughly about just over half of a UK listed business called GKN PLC. And so GKN back in 2017, 2018, it was kind of an industrial conglomerate. It had an aerospace business. It had the existing Dowlais businesses. It had some other industrial businesses that have subsequently been divested. And so it had struggled. It had kind of perceived issues, performance issues. Melrose, being a kind of a turnaround specialist, launched a hostile takeover for it. It kind of lasted about 2 months. Previous management, who aren't with Dowlais anymore, but prior to Melrose's ownership, previous management tried to avoid or tried to rejected Melrose approaches. They tried to get a white knight deal with US listed Dana Incorporated, buying the GKN auto business, which is 80% of today's Dowlais business. And that was rejected by shareholders. So Melrose won the takeover. They offered more money to buy the whole thing. And I think shareholders at the time, GKN shareholders at the time, probably had gotten tired of the former management team at GKN. So Melrose acquired the business, the entire GKN business for, I think it was about 9 times EBITDA, about 8.6 billion pounds sterling, but roughly about 9 times EBITDA. Dana had bid for just the auto part of GKN at the time. I think it was about between 7 and 8 times EBITDA, which would have equated to a value, an enterprise value of about 4.5 billion at the time. So that was kind of, they were kind of the valuations being attributed to the GKN business at the time, and the Dowlais Auto business. And when you think about the 9 times multiple that was Melrose paid for GKN, the majority of that business, 60% plus of the old GKN business, was Dowlais, or the Dowlais Auto business, and the Powdermet element as well. So I think they're useful historic valuation benchmarks. And obviously they're a different time. Interest rates, cost of capital was lower then than it is currently. But again, I think it's relevant. And I think, when you look at then Dowlais today, so, fast forward 5-6 years, it went through a restructuring. Melrose sold off the heavy commercial vehicle element of the old GKN auto business. They slimmed it down. They trimmed working capital. Being turnaround specialists, they just applied their model to it. And then when they felt that they had taken the restructuring program to their end point, and they were more focused on the aerospace business, which is what they retained, they spun off the auto business as Dowlais, and they included the Powdermet business along with it, because a significant chunk of Powdermet's end markets is the auto market as well, or auto parts, even though there are other industrial end markets for Powdermet's products. So, when you look at that history and those type of valuations, and then you look at the valuation of Dowlais today, and you think, okay, it's an 800 million or 830 million market cap. It's a 2.3 billion enterprise value when you include net debt and some pension obligations. But as I said, when you back out the Powdermet valuation, that looks more like a 2 times multiple or sub 2 times multiple on the core auto business. It just, for a business that has been tidied up, has a good management team in place, and the different attributes, the positive attributes I mentioned there, it just seems too cheap.
Great. Let's talk about a little bit about margins, right? So they had previously been guiding to margins expanding this year because of all the issues we've been talking about. They're talking about margins contracting, but they've done a lot, right? I think historically they've said, hey, new contracts are coming in. Correct me if I'm wrong. Yeah. New contracts are coming in at higher margins than our old contracts. So that, as the new contracts kind of kick in, should expand margins. I think they've done some restructuring. I've seen a lot of auto part suppliers do this. I think they opened up new plants in Hungary and Mexico. Obviously those can be a lot lower cost places to manufacture than the United States. Let's pick one. So I just want to talk to you about, we're not getting the margin expansion this year. Do you think that is the margin expansion is never going to happen? And you could think of a lot of reasons why, even as they're moving to lower cost places, the margin expansion doesn't happen. Or do you think this year is just unique, and maybe 2025, we roll the corner, these guys give loose guidance. Like, I could imagine they come out 2025 and they say, hey, volumes have stabilized. All of the initiatives we talked about are kicking in. Margins are going up. Free cash flow is going up. And the stock kind of races as people can re-underwrite. So threw a lot to you, kind of made it a softball towards the end, but I'd love to get your thoughts on just margin expansion and the initiatives they've taken.
Yeah, no, it's an important question. So, so at the time of the spin-off, so management in the auto business, which again is the core segment, 80% of revenue. So the target margin, medium-term target margin that management are shooting for is a 10% EBIT margin. It was 7% in FY23, then half year this year, 24, with all the issues that have been going on, it dropped to, on a headline basis, 5%, because that's due to lower volumes, particularly on the EV side of the business, where the EV volumes are down, so components sales have been down, and that kind of hits the margin. So now 5% sounds like a significant drop, but what management actually managed to do, and I think it speaks to their ability in a difficult trading environment, is that they implemented some restructuring and cost saving initiatives. So they passed on cost increases, energy, components, parts, labor costs. They passed that on to manufacturers. And again, because of their entrenched relationship with all these OEMs, a lot of them just have to take the cost increases. So they actually managed to deliver margins or EBIT margins of about 6% in the half year, and they're guiding 6 to 7% for the full year, with some kind of pickup in the second half of the year. So, so where are we today? We're kind of 6.5, 7% is kind of the thinking current year, with the benefit of management's cost initiatives and performance initiatives. So management have indicated that through some of those continued cost initiatives, and some of them are, as you mentioned, kind of they've closed a plant in Germany. German manufacturing is in a really difficult place, and they've closed that plant and they've opened a new one in Hungary, a much lower cost jurisdiction. Similarly, they've opened a new plant in Mexico. They've shut one in North Carolina. So that kind of near shoring trend in terms of to kind of manage the cost base in a difficult environment. So management think that they can get margin expansion of about 200 basis points just through cost initiatives, even if production volumes stay where they are. So kind of sub 90 or kind of high 80s. And so how do you get from that? So you got 6, you got maybe 2%, then that gets you to 8% with just performance management initiatives from management. And then that leaves you a 2% gap to get to your 10% target. And what that needs really is volume pickup over time. And, kind of back above 90 million units cars by next year, that should get them to a 9% underlying margin. And then beyond that, then it's through, I suppose, a combination of maybe if it continues to improve back to kind of towards pre-COVID levels of, kind of low 90s in terms of production volumes, and maybe some further kind of cost initiatives from management. That kind of, there is visibility there to the 10%. And, I think, does that require you to kind of hope that management can deliver? I think, yeah, obviously you kind of management, you kind of have to back management here in terms of delivering that. And they've already the last 6 months, they've insulated margin by about 1%, while volumes have been down unexpectedly. So they've shown, I think, a good degree of competency there in terms of protecting margin. And if and when volumes do return, I think that gives good, that shows that kind of 10%, I think, is within sight. And, in terms of my own analysis, I'm assuming kind of, FY26, FY27, kind of 2-3 years out from now, even at 8% EBIT margins on the auto side, which is what I'm assuming. I'm assuming I'm not assuming the management case, and I'm still getting a kind of a value of, over £2 a share on that basis. And that obviously that includes kind of monetizing the Powdermet segment as well. But, so I think, margins, I think, can they get to 10%? Yeah, I do. Yeah.
You mentioned management a few times in there. Earlier, you'd mentioned some management insider buys earlier this year. So I just want to pause there and ask, we don't have to compare management here to Steve Jobs or anything, but I want to pause here and ask 2 things on management. Like, how do you view the current management team would be one, because I think people could take 2 views. Like, hey, they're dealt a really effing tough hand would be one. Or number 2 would be, hey, these guys, they're getting, they're lowering guidance every year. The stock's been a disaster since the spin. These guys have no clue what they're doing. So I think both views could be looked at and you could debate fairly. So I want to take your view on management. And then the second thing, any spinoff, the first thing I'm always looking for is incentives, right? The incentives of the management team, the incentives of the directors. Obviously, there's been some insider buying, but I'd love to just talk about the incentives of the management team. Like, are they aligned with shareholders here? So you can start at either one you want, but I'd love to talk about both of them.
Yeah, I think, just taking kind of 2 sides of that. So operationally or in terms of competency, I think management are good. So the first thing I suppose to kind of point out is that the management team here, these are the current management are the management that Melrose installed when they took over the business and embarked on their kind of turnaround plan. So these aren't the legacy managers that were involved pre Melrose and pre-spin. So the current CEO was brought on board by Melrose, and he was the guy that led the kind of cleaning up of the business under Melrose ownership. And he stayed with the business post-spin. So he kind of, he knows the business. He understands the business. He's a good operator. And I think, in terms of the measures they've taken this year, I think they've shown, in terms of cost management and protecting margins, and shown operationally, I think they're good managers, they're good operators. And I think, you can take some degree of comfort in their ability to kind of, to drive this business on and to kind of, as the market improves, they'll capitalize on that. In terms of incentives, okay, so there isn't a huge amount of insider ownership in this, and that's the one thing I'm less happy with in terms of the situation. The management there isn't a huge amount of insider ownership. Now there are incentive plans in place that incentivize management to kind of buy stock and performance linked share awards, and they could end up owning if they hit their targets, they'll end up owning a decent chunk of a decent chunk of the company. That certainly would kind of align them with the rest of the shareholder base. And I think sorry, lost my train of thought.
No.
On the incentives. Sorry, yeah, the incentive plan. Sorry, the incentive plan. So it's linked to kind of total shareholder return metrics, free cash flow, operating profit growth. So the kind of things you would want to see in terms of metrics to kind of hold them to account. So I think they are well incentivized to try and turn the business around from the current kind of the challenges that it faces.
No, that's great. So let's talk about the incentives a little bit, because that is the one place where when I looked at this a few years ago, I remember like, I was kind of hoping like you spin off this low multiple business that spits off a lot of cash flow. I was kind of hoping, pulling numbers out of thin air. I love it when I see, hey, the stock is spinning at 200. We're giving management, a huge stock option bonus, 5 years option struck at 300, right? Because if he goes 200 to 300 over 5 years, people aren't going to be thrilled, but they'll be generally happy. That's a very nice IRR, right? Not the best in the world, but if you give them options at, and again, I've just pulled the numbers out of there. If you give them options at 300, they actually have to get it well above 300 for those options to really be worth it. So you've got like a greedy, incentivized management team. And I've heard people say here, like, look, you've got the insider buying. I think some of the directors, you can correct me if I'm wrong, or if you don't know, that's completely fine. Somebody mentioned to me some of the directors have a really interesting incentive plan that expires next year, and it would require the stock to get a lot higher. You've got a buyback coming, but at the same time, I look and I'm like, hey, for a business that's kind of just supposed to be not a growth business, kind of cyclical and steady, the stock buyback's pretty small here. Maybe that changes if they sell powder, but I'd love to see them just ingesting shares and destroying the share count. I don't think I see a management team that's like YOLO incentivized here. So I'm of two minds. I'd love to just continue the conversation with you on the incentives.
Yeah, so no, you're right. Firstly, just on the point on the buyback, I suppose it is a small buyback. I suppose that's constrained by the capital available at the moment. I mean, they post spin-off, they have some debt, they're trying to deleverage that. They've earmarked the Powdermet segment to sell that, and when they do that, that will transform the balance sheet and will give it plenty of scope for much stronger capital returns.
Do you think if they sell Powdermet, do you think we start seeing, like, I've seen this in some of the UK companies that we've followed together? They sell the division and then it's, hey, huge capital return, whether it's, OCI with huge dividend, or here it'd be really nice if they just said, hey, we sold it for $1 billion. We're going to buy back 20% of our shares in an ASR or something. Like, do you think that's how it plays out?
I would think that's how what they'll do. Yeah, I think they might go for a buyback and maybe a special distribution, some kind of combination of the two. But certainly a buyback or an expanded buyback would be the logical one. I mean, just because it should be so accretive, just given the current valuation. So I think that's just on the buyback point. And then on shareholder, insider buying recently, the CFO and the CEO have started buying shares. They were buying shares when it dipped below 60 pence there recently. So I think that's kind of a sign of confidence in terms of going out into the open market and buying stock when obviously they feel it's on the floor. So I think, that gives you some kind of comfort that management are kind of they see value there. And then in terms of kind of the broader incentive scheme. I think, they get share awards. I think they're incentivized to, I think it's to build a stake of up to 300% of their annual salary in stock. And so that's kind of there's a kind of I suppose a pathway there for them to build a shareholding in the company, and that only becomes more valuable then if they do implement a buyback, a bigger buyback down the line, and they're holding, they own a bigger slice of the pie then in that instance.
No, look, it's a great point. I guess the two things, and again, this can be one of the tough things with cyclicals or with companies in general, but the two things that jump out is, A, they did a share buyback, they did insider purchases this quarter, but they also did last quarter when the stock went from last quarter, the stock goes from 120 to 90, and they come and buy about 500,000 shares on the open market. And then this quarter, the stock goes from 90 to 60, and they buy about 500,000 shares on the open market. So I'm kind of like, hey, do these guys see value, or is this just, hey, let's try to boost the market's confidence a little bit? Obviously, they need to get to that 3 times hurdle, which isn't, that's kind of standard. But so I could be of two minds to that. And then I was trying to flip through and find the incentive structures on here, like I do see the adjusted cash flow and everything. I just can't find it. But yeah, I don't see anything that says these guys are being super greedy, because what I always worry about is, this isn't just a Dowlais specific thing, but if you're an exec who doesn't own a lot of stock, then you're not really incentivized to catalyst yourself, because the value's there, right? You can just be like, look, next year I'll go buy back the stock, but in the meantime, I'll accrue more options at a cheap price, or I can buy stock on the open market at a cheap price, and it doesn't really matter to me. I'll do it next year. I'll sit on that cash. And earn interest income. Or the real negative here would be they sell Powdermet for a big multiple, and then alongside it they say, hey, we're doing this super synergistic acquisition and doubling down on the core business. You'd be like, no, the core business is trading at 2x. So those are the type of management misalignments, and I need to do more work on that incentive structure as well. But that's one of the things where I just love to see spins where they come out and you're like, oh my God, these guys are greedy for shares. These guys are hungry for it. These guys want to get the stock working.
Yeah, well, as I said, I think the level of insider ownership and I suppose that goes to incentives. I suppose that's the one area where you would like to see more a stronger kind of setup in this company. But I think you have to look as well though at the actions that they've taken. This is a newly independent company, and in the space of 18 months. Prior to kind of the half-year update, the numbers had actually been pretty good until kind of the slowdown had started to hit the market kind of by Q1 this year. But prior to that, year-on-year growth had been solid. Free cash flow generation had been good. They were, doing as they said they would. They said at the very outset that they were going to look at, selling Powdermet. They seem to be in the process of doing that. They got rid of the hydrogen startup, which was loss-making, to kind of, to kind of boost earnings, because that was burning cash. They launched a buyback. It's a limited buyback, but it's probably about as much as they can allow for at the moment until volumes pick up and/or Powdermet can be monetized. They're buying back stock themselves. They've implemented some really I think important performance initiatives that have protected margins. So I mean, they have taken a number of measures that show, they are trying to, create value or unlock value for shareholders. They are trying to steady the ship at a difficult moment in the industry, and they're taking actions. They're not sitting back collecting big salaries and kind of just saying, "Oh, it's the market. There's nothing we can do." That they are actually doing things to try and create value, or that will generate value in time for shareholders.
They sell Powdermet, right? Let's assume they sell Powdermet for what's a mid-case number that you think they'd sell Powdermet for?
Oh, I think it could be 1.1 billion sterling, something like that.
Let's use 1 billion to make the numbers easy, and the enterprise value right now is 2 billion to make the numbers easy. And we'll adjust it in a second, but they sell it. They're left with a core business that's trading for about $1 billion EV. Actually, I was 100 million too punitive on both ends, so it's actually closer to 800 million. But let's use the 800 million, and now that I've walked people through that math, right? 800 million. We've talked about it's trading for the stub business trading for maybe 2 times EBITDA, so 400 million-ish in EBITDA. Tell me if I've been wrong with any piece of that, and hopefully it's true. I guess my question is, what's the end game for that business, right? Because we could paint a lot. We could say, hey, they sell it, their debt problems pay down, selling the Powdermet basically pays all their debt. Now we've got a return of capital story, right? These guys get the memo. They get the memo that oil and gas companies got in 2022, that most cyclical companies have gotten to this point. Hey, investors aren't going to fund you. Buy back shares, return the capital, your return of capital story. They get that memo. That's number one. Number two, my big worry with a company that doesn't have huge shareholder incentives is they go buy something, right? Hey, we got $1 billion. We sold an asset for 10x. Let's go buy a bunch of assets for 3x. This business is going to be way bigger. We can pay ourselves bigger salaries, bigger bonuses. Shareholder value be damned. We're bigger. We deserve more. That's number two. Number three, chairman. It strikes me. I'm looking at the proxy right now. He's appointed when the spins. He's got 35 years of investment banking experience, including Dutch Shell's $52 billion takeover of BG Group in 2016, retires from investment banking in 2021. He starts his career in 85, so he's probably about 65 years old. CEO starts his career in 86, probably about 65 years old. He was at Melrose. Melrose has a lot of history with acquisitions and stuff. I'm sure he picked up something through osmosis to them. You could tell me that you've got some old guys who are setting up to sell the business and put themselves into retirement, right? So I laid out three options: share buyback, return on capital story, go grow stuff story, sell the whole company story. Which do you think it would kind of play out as post a Powdermet sale?
Yeah, I think what will, I mean, they've demonstrated kind of, an appetite or an awareness of trying to drive shareholder returns. So I think that they sell Powdermet. Then that stabilizes the business, provides scope for capital returns of some form, whether it's distributions and or buybacks. At which point, based on current market forecasts, the industry volumes should recover, pick up again, so earnings should grow. And at that point, it's, you have to remember as well, the auto industry, it's going through a lot of upheaval at the moment. Auto parts is fragmented, and I think you've got the RemainCo is a market leading auto business with today 800 million market cap. Maybe that goes to $1 billion or more once they sell Powdermet and return capital or return cash. So that's still a small to mid cap business. You would think consolidation is going to happen in the market, and I think it's more likely that the RemainCo here gets acquired by, you look at Apollo buying Tenneco there recently, a couple of years ago. You look at Dana previously tried to buy the auto business here of Dowlais back in 2018. That's a logical combination, as a strategic acquirer. So I would think they return capital post Powdermet, and then, as you rightly pointed out, in terms you look at the profile of and the experience of the management of the team and the people on the board, these are M&A guys. They've been in this since 2018. It'll be nearly by the time this thing turns around, in terms of market recovery and volumes, it could be, nearly 10 years, these guys being involved. It would seem an obvious kind of a sale of the business situation then at that point, where a strategic or a private equity acquirer comes in and pays an attractive multiple to buy out the RemainCo, and that's how shareholders today would be paid.
One more question on Dowlais. As we've talked through this, I think we've done a nice job addressing industry, addressing history, all this sort of stuff. As we've talked through it, it's become clear to me that just listening to you, and I just hadn't put two and two together, maybe because I can be slow. A lot of this thesis is resting on the Powdermet sale, right? Because the consolidated company trades for, call it 4x EBITDA. A huge piece of this thesis, you said it when I asked you what your variant view is, Powdermet sells for high single, low double digits. And you've listed in your article, you listed at the start of this interview, you listed all the reasons for that. But I guess who's the buyer and what gives you confidence? Like, I do worry, just again, there's more to auto. There's more than auto at Powdermet, but I do worry when we start talking about the last transaction was 2013 in this space, or the 2018 bidding war. The space has evolved a lot. It's kind of trial times right now. And I kind of worry, if they get 8 instead of 10, 6 instead of 10, the whole thesis kind of starts to fall apart on itself. So I just want to ask you about your confidence in the Powdermet multiple sales process happening, all that.
Yeah, so I think, I mean, I suppose firstly, who's the buyer? And you mentioned there the really direct comparable. It's 2013, I think, when that traded. I mean, but that kind of reflects. I mean, powder metallurgy as an industry is a pretty small. As in, there's not a wide number of players. There's only a handful of players in it. Um, uh, Dowlais Powdermet business is the number two player globally behind Höganäs, which was the Swedish company taken private in 2013. So they're the top two kind of pure play powder met players in the industry. So who's going to? So it's an attractive asset in a specialty niche industry with, as I said already, 15-16% EBITDA margins, 70% plus free cash flow conversion. So and it has a number of industrial applications or end markets, not just autos. So I think it's a reason, and if you look at the kind of historic trading over time, it's pretty stable. I mean, there's not a huge amount of fluctuation in powder met revenues like you would see in an auto parts business, in a more conventional auto parts business. So it's kind of a bit more stable in terms of the profile. So I think it's a relatively attractive industrial asset for an acquirer, whether that's a private equity player or whether that's some of the US comps that I meant, the listed comps where they're in powder metallurgy and other kind of alloys and alloys related industrial processing or metals processing. So this could be a fit for them as well. Within its segments in the powder metallurgy industry, it's kind of either number one or number two in its subsectors. So it's an attractive asset. It would appeal to other industrial players or acquirers or private equity, mid-market private equity. So I think that's, in terms of the buyers, I think that's kind of gives a sense of who would buy it. And I think, but just back to your other point as well, does the whole thesis hinge on a sale of powder mesh? It's certainly, I mean, as an event-driven situation, which is how I'm looking at it, it is one of the main thesis points. But as well, just to go back to the business's position, quality within the industry, its exposure to the different end markets, within where there's China and Chinese EV production and so on. It's auto parts is a cyclical industry, and while it's going through a tough time at the moment, it's very reasonable to think that volumes will pick up and recover again over a medium term, and this business will obviously benefit from that as one of the leading suppliers in that space. So I think that the fundamental business turnaround story or market volume recovery story is also a thesis here. For the business.
Quickly on Powdermet, I'm just trying to make sure I understand it. Like I read your write up and looked at it, and as you're talking, I was kind of looking at the website. Like I understand what they do, right? They take, correct me if I'm wrong, they take brass into a bunch of powder, and instead of heating it up to shape it, they basically press it together to make it, right?
Yeah, exactly. So they take metal, like say bronze or something like that, in powder form, and they compact it into shapes, or using molds into shape with heat, but not melting it. And the reason that you do that is that it forms. It's easier to shape, and for various kind of components in industrial manufacturing, autos, everything's different shapes, and they have to be a certain way, and so it's easier to form rather than melting things down and letting them cool and so on. So it's a kind of a more efficient way of producing hard-wearing metal components that could be used for autos and industrial parts. So that's what it does. So it's very fundamental industrial business.
I have a question, and then I have like something that light bulbed as you said that. Question is, why isn't this cyclical? Or it is cyclical. Why isn't it more cyclical? I'm kind of surprised this isn't more cyclical, just because that seems like about the type of thing that's extremely exposed to industrial, auto, like all that. It seems like it should be about as cyclical as it gets.
Yeah, but I think you think of the range of uses. It's not just autos is a big end market, but I mean, like these aren't kind of, again, these components are critical components. They're not like, for special, add-on features in equipment or in vehicles. I mean, these are, fundamental, essential components. So they go into everything. A certain stock of them has to be maintained. And, manufacturers buy them buy them in bulk so that there's always a kind of a ready-made store of them available for production. So, I suppose over time, it's a less variable. The demand seems to be less variable than kind of conventional kind of auto parts.
I'd like to do more, but I guess the reason jumps out to me because you mentioned in your write-up, hey, the carrying value here is about 860 million, and when we're talking about selling it for $1 billion ish. The thing I was going to push back, I was like, hey, this, as I look through it, and this seems like something that's very commoditized, it's very commoditized, right? If you're going to sell it, like, why should I give it a multiple? Why should it get a return on capital? But then the answer is, hey, it's on their books for 860 million, right? Like, Conor is not talking about selling this thing for it's actually not a big premium to the asset value. He's kind of talking about selling it for asset value. So that was just like something interesting that clicked as we were talking.
There is that point. And also the fact that, again, as I said, there's only a handful. I mean, there's Höganäs, there's the Dowlais Powdermet business, and there's only a handful of other, it's not like there's a whole range of suppliers in Powdermet that different industrial businesses can go and buy components from. It's an oligopoly, I suppose, in one sense. So, you've got there's a limited number of places you can go to buy these types of metal components. So, the Powdermet business here is one of the main players. So I suppose that, again, kind of might kind of explain why there's less variability, in that it's more of a closed market in terms of the number of producers.
This episode is brought to you by Tegus, the future of investment research. Look, if you've been reading my newsletters, you know how often I rely on Tegus for my research. I probably read 1 or 2 expert calls a day, probably average 7 a week off of Tegus. They've got the largest transcript library in the world with over 75% of the private market transcripts. Whether you're curious about AI, biotech, or any niche market, Tegus has the insights you need. What sets Tegus apart is its all-in-one platform. It's packed with expert call transcripts, management checks, panel calls, and in-depth financial data. No more jumping between different services or piecing together fragmented data. With Tegus, everything is right at your fingertips. The best part? The insights you get are from the very people shaping the industries you're interested in. You'll find perspective from insiders and executives that you can't get anywhere else. To see Tegus in action and understand why it's one of my go-to resources, visit tegus.com/value. That's TEGUS.com/value. Trust me, once you try Tegus, you'll never look back. Perfect. Anything else we should be talking about with Dowlais or anything? I think we've done a pretty good job. I obviously need to do a lot more, both based on this conversation. And I got kind of close, fortunately for me. Well, I say fortunately, I got kind of close maybe 9 months ago. So I'm still kind of relying on some of that research. But, I say fortunately, but I'm sure all the stuff I invested in has been just as slashed as this. But anything else we should be talking about with Dowlais?
No, I think it's one of these stocks that, it's a spin-off. So, I mean, it's all, in one sense, the declines and the share price decline since it's been spun off isn't that surprising. You've got a lot of mandated selling by, Melrose former parent shareholders that don't want to own a small cap auto parts business. But I think, it's one of these stocks that no one really looks at it. You think about people like David Einhorn, who spoke about, the market structure, it's broken, and, the certain stocks, value stocks, that just, there isn't a bid for them. And I really think this is one of them. And when you look at a headline basis, you think, 4 times EBITDA, consolidated basis, auto parts name, UK listed, which UK has been out of favor in terms of, well known that UK stocks have been much cheaper than kind of US peers, for example. So, it kind of ticks all the boxes of why people would not be interested in, or investors wouldn't be interested in it. It's where it's listed, the industry it's in, what's going on in the industry at the moment. And that kind of, that explains, I think, why it's cheap, why it's overlooked. And then, when you look under the bonnet here and you look at kind of what's actually within this business, it's not just an auto parts business. There's a very valuable industrial metals business as well that isn't really reflected in the price. So I think it's one of these kind of, classic overlooked stocks in an unpopular part of the market. And I think, back to kind of the earlier point about, who buys this, or how does it all play out? I mean, if they sell the Powdermet business, it's probably too small to remain an independent publicly listed company at that point, and seems like a very, very ripe candidate for a mid-market private equity, takeover. And I kind of think, that's kind of I think, if the public markets don't value this properly, the private markets eventually will.
If I could just add one thing, and another thing that as we were talking that jumps out to me as interesting is, look, goodwill on a balance sheet, right? Whatever. It can mean anything. Stocks can trade anywhere, whatever. It's an accounting function. But yeah. I am always kind of interested, these guys, so their book value, and you can correct any numbers you want to that you think I'm wrong on or anything, their book value is about $2.2 billion here. And all of that is goodwill, basically, right? So if you took out the goodwill, their book value would be about zero. So it's not like it's negative tangible equity or anything. And these are businesses, so whatever. But I'm just always interested in that because they just took a big write-off of their goodwill at the end of last year, right? They wrote off Powdermet goodwill by about $400 million, and I think they wrote off some other assets. So yeah, it was a pretty nice write-off. And I'm always interested in that because look, when they test these, they put in their assumptions, they tell you, and they took a write-off. They didn't write it off to zero. They wrote off their goodwill to about 2.2 billion. So they told you at the time when we, run our DCF, whatever, that's what we kind of think the business is worth above tangible assets. That's the only way you can get to that 2.2 billion. Now, have results since then been worse? Sure. Has the industry kind of started to trowel? Hopefully started. Sure. But, they said it was worth 2.26 9 months ago. The whole company's worth $1 billion now. Like, it's a pretty interesting discrepancy. I don't know if you want to talk anything there. I
think that was one thing. It's ironic that, when they announced that impairment charge last year, it related to the Powdermet business, and everyone, the market reaction was, oh, there's problems with the Powdermet business. It's struggling. There's something going wrong. Wrong with it. It reported, I think, revenues were pretty much flat year on year. EBITDA was flat year on year. So it's not like there was a profit warning or a nosedive in earnings in that segment. The write-off really, I think, was two kind of factors behind it. So interest rates, so the discount rate had gone up because interest rates had gone up.
Yep.
From compared to December 22 to December 23, you've got a big variance there just on that alone. And then I think they pared back some of their forward or future growth expectations. Not that it wasn't going to grow, but just that instead of I forget the actual growth rate, but they pared it back to something like a 2 or 3% growth rate as opposed to something higher than that. So
I'm looking at it. So I can tell you right now, as you said, the discount rate goes from 12% to 13.4%, and the long-term growth rate goes from 3.9 to 3.3. And there's interesting language around it. It says management believes this business has promising longer-term prospects, but the medium term is lower than we thought it was. So, again, accounting construct that is dated, but it's just something that struck me as interesting because, I think Powdermet's kind of been on the table for a while. And when you take that goodwill write-off, I've seen crazier things than someone writing a goodwill down from $1 billion to $750 million and then selling it for $300 million the next day. Yeah. But, you generally, it's not a great look. You generally kind of slash these to a level where hopefully, absent a huge another turn or something, you're not having to slash it, or that if you're selling it, that the bids aren't too far off it. So anyway, we have talked a lot. I wanted to pounce through a few other things, but my parents, my 10 months old grandparents are in town, and sometimes it feels like they're fantastic. I love having them, but every now and then around lunchtime or something, I kind of feel like they need more babysitting than the 10-month-old. So I'm going to have to run there. But Conor, it was fantastic having you on for the third time. Link to the Dowlais, and you've written quite a lot on this. Link to it in the show notes. People should go check out Value Sits, and I'm looking forward to having you on for the fourth time. And one day, either I'll go across the pond, you'll come across the pond, and we'll put some alumni, because we used to work for the same firm. We'll put some alumni faces and full bodies and everything together. But thanks so much for coming on. Looking forward to the fourth time.
Sounds good. That's great, Andrew. Thanks for having me on. Enjoyed the conversation.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.